Today on Forbes, the AI data center gold rush is leaving the landlords behind. Swollen with seemingly insatiable demand for computing power, the AI boom has birthed hundreds of unicorns out of thin air, minted dozens of billionaires, and alchemized more than $1 trillion in market value for big public tech companies like NVIDIA, Broadcom, Google, and Meta. It's also inspired an infrastructure land grab perhaps unprecedented in financial breadth. Earlier in January, Meta CEO Mark Zuckerberg announced plans to build out tens of gigawatts of AI infrastructure this decade and, quote, hundreds of gigawatts or more over time. At $50 billion per gigawatt, that'll likely cost trillions. Boom times for AI infrastructure should mean banner years for the companies that have historically provided it: data center real estate investment trusts, or REITs. Yet three of the biggest, Equinix, with a $78 billion market cap, Digital Realty, with a $55 billion market cap, and Iron Mountain, with a $27 billion market cap, aren't seeing them. Their share prices are down 13%, 11%, and 16% over the last year, respectively, compared to the S&P 500's 17% increase. These companies are the landlords for the internet. They buy real estate, build data center shells with supporting infrastructure, and lease the property to tech company tenants. They should be killing it. They're not, and it's likely because of a few things: lower appetite for risk, power constraints, and lack of access to more and more speculative capital. Mark Giorelli, an analyst for Morningstar, says that right now, the market believes that chips from Google, Broadcom, NVIDIA, and others, quote, will capture the economic profits of AI, not mercenary data center developers like REITs. Michael Funk, an analyst at Bank of America, says it doesn't help that the top 20 data center development contracts signed in 2025 were won by companies other than data center REITs like Equinix and Digital Realty. Part of the challenge lies in the REIT structure itself. It was originally designed back in the 1960s to let ordinary people in on real estate investing by not charging corporate income tax and requiring that any REIT company pay out 90% of its taxable income as dividends to shareholders. Data center REITs started popping up around the turn of the century and largely accomplished their mission. Their share prices have more or less mirrored market indexes since, until AI and its gargantuan data centers took over. Now it's not working out so well. Needing to pay out such a hefty dividend leaves them with less capital for reinvestment in an industry where capital is king. So it's harder for public REITs to commit up front to the same colossal sums of capital their deep-pocketed rivals are touting. That's a tough row to hoe in this new era of data center bidding wars. Andy Savengros, co-lead of the U.S. data center markets team at public real estate firm JLL, says that as a REIT, quote, you can't stick your neck out there in the way others are doing. He adds, quote, it's really held them back in a big way. To land the big deals, Equinix, Digital Realty, and Iron Mountain need to compete with a snowballing list of well-funded companies. Some, like Meta, which is both building its own data centers and leasing them from other firms, are bankrolled by cash cow revenue streams. Others, like private companies Vantage and QTS, which both build and operate data centers, are increasingly partnering with big investment firms. But REITs' spending power is limited by their risk-averse shareholders, who are more akin to investors in pension funds rather than those betting on tech stocks. REIT shareholders simply don't want these companies to invest in deals involving debt with a non-negligible risk of default, which, these days, is often what's needed to build a data center. In addition, REITs often borrow less than 5 times their equity, compared to private companies' leverage ratios of 10 to 15x. For full coverage, check out Phoebe Liu's piece on forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.